Hello everyone. In this lecture, we are going to study audit sampling techniques. Before we start it, please be reminded that your course project topic is due this week. Please send me your course project topic for evaluation. This lecture will be presented by Professor Qi Liu. Compared with previous lecture, this one is more difficult in my opinion. So I have shared several links to you to help you understand these concepts, and I hope you to spend more time on this lecture.
In this lecture, we are going to talk about the audit sampling techniques. First, let's take a look at what is audit sampling. Auditing standards define audit sampling as the application of an audit procedure to less than 100% of the items within an account balance or class of transactions for the purpose of evaluating some characteristic of the balance or classes. While technology has reduced the number of situations where audit sampling is necessary, like in the previous lectures, we always discuss the analytics that used on the whole population of the client's data. But technology will never eliminate the need for auditors to rely on sampling to some degree, because there are many control processes require human involvement to operate effectively, like the reconciliations review, the resolution of systems-generated exception reports. And also there are many testing procedures required the auditor to physically inspect an asset, like the inventory, or to inspect the characteristics of a transaction or balance, like the terms in a contract. And also in many cases, auditors are required to obtain and evaluate evidence from third parties, like letters confirming accounts receivable balances from client customers. So these situations require the auditor's hands-on attention. When the number of items or transactions in this population is large, it is not economical for auditors to test 100% of the population. Instead, they can use sampling to gather sufficient audit evidence. Now I'm going to introduce several important definitions and key concepts in the audit sampling. These terminologies include the sampling risk, confidence level, tolerable and expected error. First, let's see what is a sampling risk. When sampling is used by an auditor, an element of uncertainty enters into the auditor's conclusions. This element of uncertainty referred to as sampling risk. Sampling risk refers to the possibility that the sample drawn is not representative of the population, and that as a result, the auditor will reach an incorrect conclusion about account balance or the class of transactions based on the sample. When using audit sampling techniques to obtain evidence, the auditor must always accept some sampling risk. Sampling risk is one reason why auditors must accept some detection and audit risk. Due to sampling risk, the auditor faces the chance that sampling may lead to one of two possible types of decision errors. The first is a decision that the population tested is not acceptable when in reality it is. And the second is the decision that the population tested is acceptable when the reality is not. In statistical terms, these errors are known as type 1 and type 2 errors. Specifically, the type 1 errors, we can also call it the risk of incorrect rejection. In testing an internal control, this is the risk that the sample supports a conclusion that the control is not operating effectively, when in truth it is operating effectively. When the auditor is evaluating the level of reliance that can be placed on a control in the context of a financial statement audit, this risk is also commonly referred to as the risk of under-reliance or the risk of assessing control risk too high. In substantive testing, this is the risk that the sample supports the conclusion that the recorded account balance is materially misstated when it is actually not materially misstated. And the type 2 risk, we also refer to it as the risk of incorrect acceptance. In testing a control, this is a risk that the sample supports a conclusion that the control is operating effectively, when in truth it is not operating effectively. When an auditor is evaluating the level of reliance that can be placed on a control in the context of a financial statement audit, this risk is also commonly referred to as the risk of over-reliance or the risk of assessing control risk too low. In substantive testing, this is the risk that the sample supports the conclusion that the recorded account balance is not materially misstated when it is actually materially misstated. The risk of incorrect rejection or a type 1 decision error relates to the efficiency of the audit. This type of decision error can result in the auditor conducting more audit work than necessary in order to reach the correct conclusion. The risk of incorrect acceptance, also the type 2 decision error, relates to the effectiveness of the audit. This type of decision error can result in the auditor failing to detect a material misstatement in the financial statements. This can lead to litigation against the auditor by parties that rely on the financial statements. Because of the potentially severe consequences of a type 2 decision error, auditors design their sampling applications to keep this risk to an acceptable low level. And auditors typically focus only on type 2 decision errors in determining their sample size, because type 1 decision errors affect efficiency and not effectiveness, and also because by controlling for the risk of type 2 errors, they also obtain relatively good coverage for the risk of type 1 errors. For these reasons, in this lecture, we don't address the potential implications on sampling applications of type 1 errors. And audit sampling can also involve non-sampling risk. Non-sampling risk is the risk of auditor error and arises from the possibility that the auditor may sample the wrong population to test an assertion, fail to detect a misstatement when applying an audit procedure, or misinterpret an audit result. The uncertainty related to non-sampling risk can be controlled by adequate training, proper planning, and effective supervision. There are three important factors in determining the sample size. These three factors are the desired level of assurance in the results. We could also call it confidence level. The acceptable defect rate, or the tolerable error, and the historical defect rate, or the estimated or the expected error. So first, let's take a look at the confidence level. The confidence level is the complement of sampling risk. Because of this, the auditors can set either confidence level or sampling risk. For example, the auditor may set sampling risk for a particular sampling application at 5%, which results in a confidence level of 95%. The confidence level and sampling risk are related to sample size. Typically, the larger the sample, the higher the confidence level and the lower the sampling risk. Once the designed confidence level is established, the appropriate sample size is determined largely by how much tolerable error exceeds expected error. The smaller the difference between these two variables, the more precise the sampling result must be, and therefore the larger the sample size needed. In typical statistical sampling terminology, the term precision relates to how close a sample estimate is to the population characteristic being estimated, given a specific sampling risk. Thus, precision at the planning stage of an audit sampling application is the difference between the expected and the tolerable deviation rate or misstatement. Auditing standards use the term allowance for sampling risk to reflect the concept of provision in a sampling application. For example, if an auditor expected that a control would have a 2% deviation rate, and the auditor was willing to tolerate a deviation rate of 5%, the allowance for sampling risk would be 3%. Now we have to always remember that in order to successfully apply audit sampling to gather audit evidence, auditors must be able to tolerate some deviations or misstatement to provide an allowance for sampling risk. The only way to completely remove this risk is to test all the items in the population. In assessing the risk of material misstatement or in auditing an account balance or a class of transactions, the auditor seldom relies on a single test. Generally, the auditor applies a number of audit procedures in order to reach a conclusion. Some audit procedures involve sampling as defined by auditing standards, while others do not involve sampling. This slide lists the types of evidence that are commonly gathered using audit sampling as well as types where sampling is generally not used. So we can see that audit sampling is commonly used when auditors inspect the tangible assets or the records or documents, and when they conduct a reperformance, recalculation, and confirmation process. But for the analytical procedures, scanning, inquiry, and observation, sampling is not commonly used. Specifically, when auditors inspect the tangible assets, an auditor typically attends a client's year-end inventory count. Because the number of inventory items can be very large, the auditor may use audit sampling to select inventory items to physically inspect and count. And when they inspect the records or documents, a control may require that before a check is written to a vendor, the payables clerk must match an approved purchase order to an approved receiving report and vendor invoice and indicate an acceptable match by initialing a copy of the check stapled to the other three documents. For large companies, this sort of control would be performed many times a day. The auditors can gather evidence on the effectiveness of the control by testing a sample of the documentation packages. When conducting reperformance, to comply with Rule 404 of SOX, publicly traded clients must document and test controls over important assertions for significant accounts. In assessing the competence and objectivity of the client's work, the auditor may reperform a sample of the tests performed by the client. Also, when conducting confirmation, a common technique to gather evidence that accounts receivable balances exist and are accurately recorded is to send letters to customers asking them to confirm their balance. Rather than send a letter to all customers, the auditor can select a sample of customers. While in a continuous auditing system, we may include function called the automatic confirmation, which the system could automatically send the confirmation letter to the customers. So in this case, if we use this technology widely, we don't need to do sampling for confirmation in the future. Although that sampling is commonly used to inspect tangible assets, records and documents, and to do the reperformance recalculation and confirmation, it is also common for auditors to use other testing approaches instead of sampling or in combination with sampling to gather evidence. For example, when an account or class of transactions is made up of a few large items, the auditor may test all the items in the account or class of transactions. Because the entire class or balance is subjected to a 100% examination, such an audit procedure does not involve sampling. More common than testing 100% of the items in an account balance or class of transaction is a technique in which the auditor tests all items with a particular characteristic of interest based on risk or monetary value. For example, if the auditor is aware of certain transactions that look unusual or present greater risk, the auditor should test all these items rather than applying audit sampling. Similarly, if a relatively small number of large transactions make up a relatively large percentage of an account or class of transactions, auditors will typically test all the transactions greater than a particular dollar amount. Automated information systems process transactions constantly unless the system or program are changed. When testing automated IT controls, the auditor may decide to test one or a few of each type of transactions at a point in time. In conjunction with that test of the automated controls, the auditor may test general controls over changes to the system and program in order to provide evidence that automated controls have been operating over the audit period. This type of test of automated IT control does not involve audit sampling. Okay. Generally, there are two approaches to audit sampling: the non-statistical and statistical. In non-statistical, or judgmental sampling. The auditor doesn't use statistical techniques to determine the sample size, select the sample, and measure sampling risk when evaluating results. Statistical sampling, on the other hand, uses the laws of probability to compute sample size and evaluate the sample results, thereby permitting the auditor to use the most efficient sample size and to qualify the sampling risk for the purpose of reaching a statistical conclusion about the population. Both approaches require the use of the auditor's professional judgment to plan, perform, and evaluate the sample evidence. The major advantages of statistical sampling are that it helps the auditor to design an efficient sample, to measure the efficiency of evidence obtained, and to quantify sampling risk. While the disadvantages of statistical sampling include additional costs of training auditors in the proper use of sampling techniques, and designing and conducting the sampling application, and lack of consistent application across audit teams due to the complexity of the underlying concepts. With a non-statistical sampling application, the auditor must rely on his or her professional judgment in combination with audit firm guidelines and knowledge of the underlying statistical sampling theories to reach a conclusion about audit tests. Therefore, to properly apply non-statistical sampling, auditors' judgment and their firm's sampling guidance must be grounded in statistical sampling theory. In fact, auditing standards indicate that sample size from statistical and non-statistical sampling plans should be approximately the same. Thus, a disadvantage of non-statistical sampling is that auditor judgment may diverge significantly from sampling theory, resulting in testing that is not as effective as statistical sampling. Most firms address this concern by providing their auditors with non-statistical sampling guidance and procedures that are easy to use, encourage consistency in sampling applications across engagement teams, and are grounded to sampling theory. Non-statistical audit sampling can be simple to use and more consistently applied than statistical sampling because some of the more difficult statistical decisions can be made by experts. The experts' decisions are then built into the audit firm's guidance and decision aids. Usually, auditors use three major types of statistical sampling techniques: attribute sampling, monetary unit sampling, and classical variable sampling. The attribute sampling is used to estimate the proportion of a population that possesses a specified characteristic. The most common use of attribute sampling is for tests of controls. In this case, the auditor wants to determine the deviation rate of a control implemented within the client's accounting system. For example, the auditor may want to gather evidence that a credit check is performed on customer orders before shipment. Measurement of the deviation rate provides evidence about whether the control is operating effectively to process accounting transactions properly, and therefore provides support for the auditor's set level of control risk. Attribute sampling may also be used with a substantive test of transactions, when such a test is conducted with a test of control as a dual-purpose test. second type of statistical sampling techniques are the monetary unit sampling. Monetary unit sampling uses attribute sampling theory and techniques to estimate the dollar or other currency amount of misstatement for a class of transactions or an account balance. Variations of monetary units sampling are known as probability proportional to size sampling and cumulative monetary amount sampling. Auditors use this sampling technique extensively because it has a number of advantages over classical variables sampling. Monetary sampling builds upon attribute sampling theory to express a conclusion in dollar amount. The last type of statistical sampling technique is the classical variables sampling. Classical variables sampling includes the sampling techniques typically taught in an undergraduate statistics class. While auditors sometimes use variable sampling to estimate the dollar value of a class of transactions or account balance, it is more frequently used to determine whether an account is materially misstated. Then I'm going to elaborate the application of these statistical and non-statistical sampling techniques in the audit test. First, I'm going to talk about the attribute sampling applied to tests of controls. The attribute sampling is a statistical sampling method used to estimate the proportion of characteristics in the population. In conducting a statistical sample for a test of controls, auditing standards require the auditor to properly plan, perform, and evaluate the sampling application and adequately document each phase of the sampling application in the work papers. So the basic process to apply attribute sampling to the test of controls include the plan, perform, evaluate, and document stage. First, let's take a look at the planning stage. Proper planning of an attribute sampling application involves completing a number of important steps. Each of these steps in turn requires the use of professional judgment on the part of the auditor. So the first step in planning is to determine the test objectives. Auditing standards require that sampling applications be well planned and take into consideration the relationship of the sample to the objectives of the test. The objective of attribute sampling when used for tests of controls is to evaluate the operating effectiveness of the internal control for purpose of the internal control audit for public companies, or to determine the degree of reliance that can be placed on controls for financial statement audit. Thus, the auditor assesses the deviation or error rate that exists for each control selected for testing. Audit sampling for tests of controls is generally appropriate when the completion of a control procedure leaves documentary evidence. And then the second step in planning is the defined population characteristics. To achieve the test objectives, the auditor must carefully consider the characteristics of the sampling population. The first stage in this step is define the sampling population. Or a subset of the items that constitute the class of transactions make up the sampling population. The auditor must determine that the population from which the sample is selected is appropriate for the specific assertion, because sample result can be projected only to the population from which the sample was selected. For example, suppose the auditor is interested in examining the effectiveness of a control designed to ensure that all shipments to customers are billed by testing whether all shipments were in fact billed. If the auditor uses the population of sales invoices as the sampling population, he or she is not likely to detect goods shipped but not billed, because the population of sales invoices includes only sales that were billed. In this example, the correct sampling population for testing the completeness assertion would be the population of all shipped goods, as documented by shipping records such as bills of lading. And the second stage to define the population characteristics is to define the sampling unit. The individual members of the sampling population are called sampling units. In auditing, a sampling unit may be a document, an entry, or a line item. Each sampling unit makes up one item in the population. The sampling unit should be defined in relation to the controls being tested. And after that, we should define the control deviation conditions. For tests of controls, a deviation is a departure from adequate performance of the internal control. It is important for the auditor to define carefully what is considered a deviation. After we define the population characteristics, we need to determine the sample size. Considerable judgment is required in determining the appropriate value for the inputs that are used to compute sample size. The three key inputs to determine the sample size are the same as those we have discussed earlier. They are the designed confidence level, tolerable deviation rate, and expected population deviation rate. Auditing standards require that auditors give adequate consideration to the appropriate value of these inputs. Because of the difficulty of making these input judgments, determining the sample size is typically the most difficult step of an audit sampling application. So then let's go to the each determinants of the sample size. First is the designed confidence level. In setting the designed confidence level and the acceptable level of risk, the auditor considers the significance of the account and the importance of the assertion on which the control provides assurance, as well as the degree of reliance to be placed on the control. Generally, when the auditor has decided to rely on controls, the confidence level is set at 90 to 95%, meaning that the auditor is willing to accept a 10 or 5% risk of accepting the control as effective when in fact it is not. However, the auditor must remember that there is a direct relationship between the confidence level and the sample size. The more confidence the auditor would like to be, the larger the sample size must be, all else equal. Thus, the auditor must balance effectiveness concerns with efficiency concerns when setting the desired confidence level and acceptable risk of incorrect acceptance. Then let's take a look at the tolerable deviation rate. The tolerable deviation rate is the maximum deviation rate from a prescribed control that the auditor is willing to accept and still consider the control effective. We can see that this table listed the examples of the relationship between the assessed importance of a control and the tolerable deviation rate. A low tolerable deviation rate, you can see such as 3 to 5%, is used when the auditor plans to test the effectiveness of a highly important control. A higher tolerable deviation rate, like 6 to 10%, is used when the auditor plans to test the effectiveness of a moderately important control. The tolerable deviation rate is inversely related to the sample size. The lower the tolerable deviation rate, the larger the sample size. Then let's take a look at the expected population deviation rate. The expected population deviation rate is the rate that auditors expect to exist in the population. Some level of deviation is commonly expected because the controls that auditors typically use sampling to test will be dependent on some human involvement, and humans are not perfect. The auditor can develop this expectation based on prior year's result or on a pilot example. The expected population deviation rate has a direct relationship to sample size. The larger the expected population deviation rate, the larger the sample size, all else equal. For example, assuming a designed confidence level of 95%, a tolerable deviation rate of 5%, and a large population. The effect of expected population deviation rate on sample size is shown in this figure. If we expect 1% expected population deviation rate, then the sample size is 93. But if we expect the 2% population deviation rates, the sample size becomes to 181. After setting the desired confidence level, the tolerable deviation rate, and the expected population deviation rate, the auditors can calculate the sample size by using some statistic tables, or so now we can use ACL to help calculating the sample size. Now I'm going to show you how to use it. Let's go to ACL. Then just open any project because it's just going to be example. Okay, in ACL you can see that there is a function called sampling. So when we click into it, the first choice is calculate the sample size. So we just click into it. Because now we're using the attribute sampling, so we choose the record here. And for example, we want to achieve the 95% confidence level. So now here we test 95 here. Then for the population, it means the total number of the records. For example, we just need to sample this accounts payable table, because now I'm opening the accounts payable table. So there are 999 records, so just type 999. You can use another table, but just make sure it's a large table that include enough records. Then for the upper error limit is here we call it the tolerable deviation rate. For example, we want to achieve the 500 5%, so we just choose 5, and then like the expected error rate, we think it's 1%, so we just choose 1. Then you could click the calculation. In here that tells you the sample size should be 95, or you can click OK. It will return the result in the screen. It just calculate the sample size for you, and the result is 95. Okay, let's go back to the slides. Then you may be a little bit surprised that the size of the population is not an important factor in determining the sample size for attribute sampling. Actually, the population size has little or no effect on the sample size unless the population is relatively small, say less than 500 items. In fact, so long as the population is made up of similar items under the same system of controls, it doesn't matter if the population is 10,000 items, 1 million items, 100 million items or more. The sample size is the same. Actually, in ACL, it completely ignores the effects of population size when computing sample size for attribute sampling. And this table summarizes the effects of the 4 factors on the size of the samples to be selected. You can see that the direct confidence design, the confidence level have direct relationship to the sample size, while the tolerable deviation rate has inverse relationship, and the expected population deviation rate has direct relationship with sample size, while the population size has no effect, or a very small effect with the sample size. Then, after the sampling application has been planned, an auditor performs each of the following steps. First is select the sample items. The auditing standards require that the sample items be selected in such a way that the sample can be expected to represent the population. Thus, all items must have an equal opportunity to be selected. The following 2 selecting methods are acceptable for attribute sampling, like these 2, random number selection and systematic selection. In an audit, the auditor may select a random sample using random numbers generated by a spreadsheet application or audit sampling software like ACL. Using this method of selection, every item in the population has the same probability of being selected as every other sampling unit in the population. Statistical sampling requires that the auditor be able to measure the probability of selecting the sampling units selected. Thus, random number selection is used in many statistical sampling applications. Auditors typically use unrestricted random sampling without replacement for sampling applications. This means that once an item is selected, it is removed from the frame and cannot be selected a second time. For example, in ACL, you can get a set of random numbers. When you click tools, then the generate random numbers. We click this. You can see that. You can first define how many numbers you want. Like we already have the sample size of 19.5, for example, we just like this 19.5 record, and then the seed is used to start the random number process. If no value is entered into ACL, then ACL will automatically create a random seed. So we just can leave this as blank. Then we need to enter the range of the records you want to choose. For example, we still want to sample this accounts payable table, then the minimum record should be 1 and the maximum record should be the 1000. Because each random number generated by ACL will be greater than or equal to the minimum value and less than the maximum value I specified. So no random number will be equal to the maximum value. So we have to set the maximum value as 1 plus the number of the records. Then we have to choose the unique and sorted, so that each random number is unique and the output is produced in sequence. Then let's click OK. Then you can see that there is a 95 numbers are randomly chosen. So you can use this number to choose the number of records. Okay, let's go back to see the systematic selection. When using a systematic selection approach to select a sample, the auditor determines a sampling interval by dividing the sampling population by the sample size. A starting number is selected in the first interval, and then every nth item is selected. When a random starting point is used, systematic selection provides a sample where every sampling unit has an equal chance of being selected. For example, suppose the auditor wishes to select 100 items from a population of 15,000 items, numbered 1 to 15,000. The sampling interval in this case is 15,000 divided by 100 is 150. The auditor chooses a random number in the first interval, like between 1 and 150. For example, it chooses 125, and that item is selected for testing. The second item is 125 plus 150 is equals to 275. Then the third item is 425, and so on. To avoid the possibility that a systematic sample will miss systematic deviations in the population, the auditor can use several random starting points. Then, after we select the sampling item, we can perform the audit procedures. In conducting the audit procedures for tests of controls, the auditor may encounter the following situations. First, the auditors may occasionally select a voided document in the sample. If the transaction has been properly avoided, it does not represent a deviation. The item should be replaced with a new sample item. While sometimes a selected item is not appropriately for the definition of the control, for example, the auditor may define a deviation for a purchase transaction on a vendor's bill not supported by a receiving report. If the auditor selects a telephone or a utility bill, there will not be a receiving report to examine. In such a case, the absence of the receiving report would not be a deviation. The auditor would simply replace the item with another purchase transaction. Sometimes the auditors may not have the ability to examine a sample item. Auditing standards require that the auditor consider the effects of not being able to apply a planned audit procedure to a sample item. For most tests of controls, the auditor examines documents for evidence of the performance of the control. If the auditor is unable to examine a document or to use an alternative procedure to test whether the control was adequately performed, the sample item is a deviation for purpose of evaluating the sample result. Also, if a large number of deviations are detected early in test of controls, the auditor should consider stopping the test as soon as it is clear that the results of the test will not support the planned assessed level of control risk. If such a case occurred in the context of an audit of internal controls for a public company, the client would be informed, and the exceptions would be considered a control deficiency unless remediation and retesting are successful or there are other controls that adequately address the increased risk of misstatement. In the context of a financial statement audit, the auditor would rely on other internal controls or set control risk at the maximum for the audit assertion affected, and appropriately enhance the related substantive test. Whenever a deviation is observed in controls, the auditor should investigate the nature, course, and consequence of the exception. The auditor should evaluate the qualitative aspect of the deviation identified. This involves two considerations. First, the nature of each deviation and its cause and consequences should be considered. For example, the auditor should determine if a deviation represents an unintentional error or fraud, and whether the deviation actually resulted in a monetary misstatement to the financial statements. The auditor should also attempt to determine whether a deviation resulted from a cause such as misunderstanding of instructions or carelessness. Understanding the nature and cause of a deviation helps the auditor better assess control risk and evaluate whether the deviations represent control deficiency. Second, the auditor should consider how the deviations may impact the other phases of the audit. For example, suppose that deviations found in the test of the revenue process resulted from improper granting of credit. As a result, the risk that the valuation assertion was not met for accounts receivable would increase, and the auditor would therefore increase substantive procedures for allowance for uncollectible accounts. After the audit procedures have been completed, the auditor proceeds with his or her evaluation of the sample results. During the evaluation of sample results, first, auditors should calculate the sample deviation and the computed upper deviation rate. Determining the sample results for attribute sampling application can be accomplished by the use of a computer program or attribute sampling table. The auditor calculates the sample deviation rate and the computed upper deviation rate. The sample deviation rate is simply the number of deviations found in the sample divided by the number of items in the sample. This calculation projects the sample results to the population and is required by auditing standard. For example, if 2 deviations were found in a sample of 50, the sample deviation rate would be 4%, equals to 2 divided by 50. In attribute sampling, the sample deviation rate represents the auditor's best estimate of the population deviation rate. However, because this result is based on a sample, the auditor does not know the true population deviation rate and must consider an allowance for sampling risk. In evaluating the results of testing and control, the auditor is normally concerned only with whether the true deviation rate exceeds the tolerable deviation rate. Because the auditor doesn't know the true deviation rate, he or she calculates a computed upper deviation rate. The computed upper deviation rate is the sum of the sample deviation rate and an appropriate allowance for sampling risk. This sum represents an upper limit on how high the population deviation rate might actually be at a controlled level of sampling risk. In other words, at a 95% confidence level, there is only a 5% chance that the true population deviation rate exceeds the computed upper deviation rate. This is something referred to as the upper limit approach. The upper limit represents the upper one-side confidence limit for the population deviation rate based on the sample size, the number of deviations, and the planned level of confidence. In evaluating the results of testing a control, the auditor is normally concerned only with whether the true deviation rate exceeds the tolerable deviation rate. Therefore, the auditor is generally concerned only with how high the population deviation rate might be. It doesn't matter how low the population deviation rate might be. And we can also calculate the upper deviation rate with ACL. Let me go back to ACL. Here, also we click sampling. You choose the evaluation arrow. Then still we are now using attribute sampling, so we choose the record. Then, for example, we type the confidence level still equals to 95, and then the sample size is also 95. Then the number of arrows, like for example, we find 0 arrows in this sample, so we type 0. Then we click OK. We'll find that the upper arrow limit frequency is 3.16%. So this is the upper deviation rate for this sample. Okay. Then let's go back. Finally, the auditors should draw their final conclusions. In drawing a conclusion about the statistical sampling applications for tests of controls, the auditor compares the tolerable deviation rate to the computed upper deviation rate. If the computed upper deviation rate is less than tolerable deviation rate, the auditor can conclude that the control tested can be relied upon. If the computed upper deviation rate exceeds the tolerable deviation rate, the auditor must conclude that the control is not operating at an acceptable level. While this table shows the auditor's risk when evaluating sample evidence on the planned level of control risk, if the evidence supports the planned level of control risk and the internal risk is reliable, the auditor has made a correct decision. Similarly, if the evidence does not support the planned level of control risk and the internal control is not reliable, a correct decision has been made. The other two combinations result in decision errors by the editor. The other two combinations result in decision errors by the auditor. If the evidence supports the planned level of control risk and the internal control is not reliable, the auditor will have incorrectly accepted the control as effective and over-reliant on internal control. It's a type 2 error. This results in the auditor establishing detection risk too high and leads to a low level of evidence being gathered through substantive procedures. Thus, the auditor's risk of not detecting material misstatement is increased. This can lead to a lawsuit against the auditor. If the evidence does not support the planned level of control risk and the internal control is reliable, it's a type 1 error. The auditor will have incorrectly rejected the control and the detection risk will have been set too low. Thus, a higher level of evidence will be gathered by substantive procedures, leading to over-auditing and an inefficient audit. Okay, that's for the attribute statistical sampling for tests of control. Then let's talk about the non-statistical sampling for tests of control. When conducting a non-statistical sampling application for tests of controls, the auditor considers each of the steps in the statistical sampling for tests of controls we have go through. While the only differences between non-statistical and statistical sampling occurs in the following steps: determining the sample size, selecting the sample items, calculating the computed upper deviation rate. First, let's talk about determining the sample size. When a non-statistical sampling application is used in determining sample size, the auditor should consider the desired confidence, the tolerable deviation rate, and the expected population deviation rate. However, the auditor is not required to use a statistical formula or table to determine sample size. Instead, guidance in audit firms, policy, and professional judgments are used to relate these factors and determine the appropriate sample size for the application. A number of public accounting firms establish guidelines for non-statistical sample size for tests of controls. Typically, accounting firms' non-statistical guidance are consistent with sampling theory and are designed to provide two preliminary benefits. One is to simplify the judgments required by field auditors by having experts at firm headquarters made firm-wide judgments. And the second one is to improve consistency in sampling applications within and across engagement team. For example, a firm may establish guidelines like this. In developing non-statistical sampling guidelines like this, the firm's experts have decided what confidence levels achieve low moderate, and high assurance. The experts have decided reasonable levels of tolerable deviation rates, and they have decided to base an initial sample on zero expected deviation. Following this guidance, if one or more deviations are found in the sample, the auditor needs to expand the sample or increase the assessed level of control risk. Then, in selecting the sample items, while random sample or systematic sampling selection is required for statistical sampling, non-statistical sampling allows the use of those selection methods as well as other selection methods, such as haphazard sampling. When a haphazard selection approach is used, sampling units are selected without any conscious bias, that is, without a special reason for including or omitting items from the sample. This doesn't imply that the items are selected in a careless manner. Rather, the sampling items are selected to present the population. Then, with a non-statistical sample, the auditor can calculate the sample deviation rate, but cannot quantify the computed upper deviation rate and the sampling risk associated with the task. The ASCPA Audit Guide Audit Sampling provides the following advice for considering sampling risk in the non-statistical type of controls. It said that it is generally appropriate for the auditor to assume that the sample results do not support the planned assessed level of control risk if the level of deviation identified in the sample exceeds the expected population deviation rate used in designing the sample. In that case, there is likely to be an unacceptable high risk that the true deviation rate in the population exceeds the tolerable rate. If the auditor concludes that there is an unacceptably high risk that the true population deviation rate could exceed the tolerable rate, it might be practical to expand the test to sufficient additional items to reduce the risk to an acceptable level. Rather than testing additional items, however, it is generally more efficient to increase the auditor's assessed level of control risk to the level supported by the result of the original sample. Okay, this is for the sampling for tests of controls. Then let's take a look at the sampling for the substantive test of account balances. Usually, to sample the substantive test of details of account balances, the statistical sampling we use is monetary unit sampling. Monetary unit sampling uses attribute sampling theory to express a conclusion in dollar amounts rather than as a rate of a currency. Monetary unit sampling, or we call it MUS, was developed by auditors to overcome the computational complexity of other statistical sampling techniques, and because most accounting populations contain relatively little misstatement. While MUS is based on attribute sampling theory, the fact that MUS is designed to test monetary amount rather than internal control effectiveness causes important differences in these techniques. The differences are driven by the characteristics of control deviations and monetary misstatement. In attribute sampling, the control either works or it doesn't. Thus, all items sampled are either correct or a deviation. Attribute sampling provides estimation of upper limit on the percentage of the time that the control is failing. With MUS, the sampling item tested may be valid and posted to the correct account in the correct period, but the dollar amount may not be accurately recorded. For instance, an invoice for 2,565 might be entered into the accounting system as 2,655. In this case, there is a misstatement, but the misstatement is only about 3.5% of the transaction. A direct application of attribute sampling to monetary items could treat all misstatements as deviations, or 100% misstatement. However, doing so will not result in a useful estimate of the monetary misstatement in the population. So MUS begins with attribute sampling concepts as a foundation, but takes into consideration misstatement counts observed in each sampling unit when computing the best estimate of the population misstatement and formulating the confidence limit around this estimated misstatement. So generally speaking, the basic underlying concepts of MUS are straightforward. The MUS uses attribute sampling theory to estimate the percentage of monetary units in a population that might be misstated, and then multiplying this percentage by an estimate of how much the dollars are misstated. MUS is designed primarily to test for overstatement errors. However, it can accommodate understatement errors if special considerations are made during the evaluation of the sample result. MUS is most appropriate for low error rate population because it provides as effective a test as classical variable sampling does, but has a more efficient sample size. Then let's see some advantages of MUS. The first is when the auditor expects no misstatements, MUS usually results in a smaller sample size than classic variables sampling. The second advantage of MUS is that the calculation of the sample size and the evaluation of the sample results are not based on the variation in the population. The standard deviation is required to compute the sample size for a classical variables sampling application because it relies on the central limits theorem. Also, when applied using a probability proportional to size sample selection procedure, the MUS automatically results in a stratified sample because sampled items are selected in proportion to their dollar amounts. Thus, large dollar items have a higher probability of being selected. With classical variable sampling, the population must be stratified in order to focus on larger items. But there are also several disadvantages of MUS, like the selection of zero or negative balances generally requires special design consideration. For example, if examining zero balances is important, like searching for unrecorded liabilities in accounts payable, the auditor must test those items separately because such items will not be selected using a probability proportional to size selection method. Alternatively, if an account such as accounts receivable contains credit balances, the auditor should segregate those items and test them separately. The general approach to MUS assumes that the audited amount of the sample item is not in error but by more than 100%. If the auditor detects items that are in error by more than 100%, special adjustment will be necessary when calculating sample results. For example, suppose an accounts receivable account contains a debit balance book value of $1,500. If the auditor determines that the correct value for the account should be a credit balance of $3,000, the account will be in error by 300%. Such an item would require special consideration when the auditor projects the amount of misstatement. Furthermore, when more than one or two misstatements are detected using a MUS approach, the sample result calculations may overstate the allowance for sampling risk. This occurs because the methods used to determine the amount of misstatement are very conservative. Thus, the auditor is more likely to reject an acceptable recorded book value and over-audit. Then let's see how to apply a MUS sampling in the substantive test of account balances. So this table listed the steps that we usually use to do the MUS sampling. It's just very similar as the steps we use to do the attribute sampling for the test of controls. So let's go to the steps one by one. First, for determining the test objectives. Sampling may be used for substantive testing to test the reasonableness of assertions about a financial statement amount and to develop an estimate of some amount. The first use, which is the most frequent application of sampling as a substantive procedure in a financial statement audit, tests the assertion or hypothesis that a financial statement account is fairly stated. The second is less frequent, but is occasionally used to develop an estimate of an amount as part of a consulting engagement, or in some cases to provide evidence on the client estimate. The objective of MUS for substantive test of details is to test the assertion that no material misstatements exist in an account balance, a class of transactions, or a disclosure component of the financial statements. Then, we also need to define the population characteristics. First step of defining the population characteristics is still to define the population. For MUS, the population is defined as the monetary value of an account balance, such as accounts receivable, investment, securities, or inventory. After defining the population, the auditors have to define the sampling unit for MUS. With MUS, an individual dollar represents the sampling unit. In fact, this is where monetary unit sampling gets its name. For example, if the population to be sampled is the accounts receivable balance of $2.5 million, then there are 2.5 million sampling units in the population. Also, we need to define a misstatement. For MUS, a misstatement is defined as the difference between monetary amounts in the client's record and the amounts supported by audit evidence. After defining the population characteristics, we need to determine the sample size. Also, we used design the confidence level, the tolerable misstatement, and the expected population misstatement, and the population size to decide the sample size. For the design, the confidence level or acceptable risk of incorrect acceptance, there is a direct relationship between the confidence level and the sample size. The basic idea is fairly simple. To increase confidence, more work is required, which is reflected in a larger sample size. For practical purpose, the acceptable risk and incorrect acceptance is the same as detection risk after considering the assessed level of detection risk based on other substantive procedures such as substantive analytical procedures. If the auditor incorrectly accepts an account balances as being fairly stated when it is actually materially misstated, he or she will allow the insurance of financial statements that are not fairly presented. The users of those financial statements may then sue the auditor for damages that result from relying on those financial statements. While there is an inverse relationship between the risk of incorrect acceptance and sample size, the lower the acceptable risk of incorrect acceptance, the larger the sample size must be. Then for tolerable misstatement, which is the maximum amount by which the account can be misstated and still be acceptable to the auditor as being fairly presented, it will always be less than planning materiality. Tolerable misstatement is also inversely related to sample size. The lower the amount of tolerable misstatement, the more precise the test the auditor needs, and the larger the sample size must be. Then for the expected misstatement, which is the dollar amount of misstatement that the auditor believes exists in the population. The auditor can develop this expectation based on the assessment of inherent risk, prior year's result, a pilot example, the results of related substantive procedures, or the results of tests of controls. As the expected misstatement approaches the tolerable misstatement, the auditor needs more precise information from the sample. Therefore, there is a direct relationship to sample size. The larger the expected misstatement, the larger the sample size must be. For the population size, in MUS, it is directly related to sample size, because MUS populations are made up of individual dollars. Populations tested with MUS are usually large. Also, the auditors can use the attribute sampling table to calculate the sample size, or use the software like ACL to calculate the sample size. Now I'm going to show you how to use ACL to calculate the sample size. Let's go to ACL first. Over here in the sampling, we still choose the calculate sample size, and then now we choose the monetary sampling. For example, the confidence we want to achieve is still the 95%, then we choose 95. And the population, for example, we have the total amount equals to $2,500,000. Now we just enter the total dollar amount as the population, and then we consider, like, if we consider the $125,000 as the tolerable misstatement, then we type it in the materiality is $125,000. Then the expected total errors, which also is the expected misstatement, as we choose it as 25,000. Let's see the sample size. We can see that after calculation, we know that the sample size is 92. Okay, if you click OK, it also returns the result to a screen. Okay. So let's go back to the slides. The next step to apply the MUS sampling is to select the sample items. In selecting the sample items, the auditor attempts to draw the sample in such a way that it accurately represents the population. The auditor can select a sample for MUS by using a systematic selection approach called probability proportional to size selection, often with the help of computer programs such as ACL. And the probability proportional to size sample selection use an interval to select sample items. The sampling interval can be determined by dividing the book value of the population by the sample size. Because the first sampling item is randomly selected within the first interval, each individual dollar in the population has an equal chance of being selected. Here we can see that in this is an example of how to choose the sample item in MUS. In this table, the total book value of the client's accounts receivable balance is $2,500,000, and the auditor determined a sample size of 93. The interval will be the $26,882, which is equals to the $2,500,000 divided by 93. To select the probability proportional to size sample, the auditor arranges the client's accounts receivable records in some order, like by customer number or alphabetically, and then create a column of cumulative dollars. Here in this column, the customer records are arranged by customer number. Then the auditor obtains a random number between 1 and the size of the sampling interval by using computer software such as ACL. Then the random number becomes the first sample item selected. Like I've shown you how to use ACL to create random number. And then the auditor adds the sampling interval either manually or with the aid of a computer program through the population and selects each logical unit that contains the computed amount. Following this process, the second customer account selected could be the Good Hospital Corporation, which contains the $30,859, this one, and this equals to 3,977 plus the 26,882. And then the third account will be 30,859 plus the 26,882, which equals to the 57,741, and it's in the item of ZP Corporation. So the auditors continue this process until the entire population has been subjected to sampling and the 93 units has been selected. Now we could also do this process using ACL. Let's go back to ACL. In ACL, in the sampling, you could choose sample records. If you have that data, you could choose sample on. Here, because we're using MUS sampling, so it's still the MUS. Then the interval, you could type the interval that calculated by using the population divided by the sample size. Also here, when you click size, you could use ACL to calculate the sample size using the confidence level, population, materiality, expected errors, etc., etc. And then the start point is the random number that you picked, and then the cutoff is the total dollar of amount. Okay. Okay, then let's go back to the slides. The advantages of using this approach to select the sample is that while each dollar in the population has an equal chance of being selected, logical units containing more dollars have a higher chance of being selected. Hence, the name probability proportional to size sample selected. Note that all logical units with a book value larger than the sampling interval are certain to be selected using this method. From an audit perspective, this approach guarantees that all individual significant accounts are examined and that in general the sample will be made up of larger accounts. This approach is particularly appropriate when the auditor is primarily concerned about overstatements, and larger overstatements are expected to be found in larger logical units. When the logic unit, a customer account in this example, exceeds the sampling interval, more than one sampling unit may be selected from the same logical unit. If this happens, the logical unit is included only once when the sample results are evaluated. Thus, the number of logical units examined may be less than the computed sample size, which is another advantage of this selection technique. Then the next step in applying MUS is to perform the audit procedures. After the sample items have been selected, the auditor conducts the planned audit procedures on the logical units containing the selected sampling units. In some instances, the auditor may not be able to conduct the planned procedures on the particular logical unit. This may occur, for example, because a supporting document is missing. Unless other evidence is available, such items should be considered misstatements. The auditor must also be careful to conduct the audit procedures so as to avoid non-sampling errors caused by carelessness, poor supervision, or mistaken judgment. After all the audit procedures have been completed, the audit evaluates the sample results. Then, in the evaluation process, first we need to calculate the projected misstatements and upper limit on misstatements. The misstatements detected in this sample must be projected to the population. The projection of the errors to the population is referred to as a projected misstatement. The auditor calculates an allowance for sampling risk and adds it to the projected misstatement. The total of the projected misstatements and allowance for sampling risk is referred to as the upper misstatement limit. So now I'm going to tell you how to calculate the projected misstatement and upper limit on misstatement using the example. Like this is the information of this example. Like the book value of this sample data is of the population is $2,500,000 and tolerable misstatement is $125,000 and the sample size is 93 and designed confidence level is 95%. The expected amount of misstatement is $25,000. The sampling interval is $26,882. This is the number in the example that we have used before. Then, the first concept we are going to use in calculating the projected misstatement and upper limit of misstatement is the basic procedure. If no misstatements are found in the sample, the projection or best estimate of the population misstatement would be $0. However, even with 0 projected misstatements, an allowance for sampling risk must be computed, which will result in an upper misstatement limit that is greater than 0. This allowance for sampling risk, when no misstatements are observed, is referred to as the basic precision. If the appropriate sample size was taken and no misstatements were found, then the auditor would be guaranteed that the upper misstatement limit would be less than or equal to the tolerable misstatement used to design the sample. For example, if the auditor finds no misstatement in auditing the client's accounts receivable, he or she will calculate the upper misstatement limit by going to locate the upper limit factor associated with no misstatements and the related sample size. In this example, the sample size is 93 and the sampling interval is 26,992. Then here is a statistical table that we could use to find the basic precision. Because this table doesn't list a sample size of 93, so we round it up to 100. Then we find that if the actual number of deviation find is 0, then the basic precision is 3.1. Or we can see that the upper statement factor is 3.1. So then the upper misstatement limit is 90,646, which equals to the 26,882 multiple 3. Then let's talk about misstatement detected. Assume that the auditor sent confirmations to the 93 sample customers selected from the client's account receivable account, and that all but 4 customers returned the confirmations, indicating the client's records are correct. Based on document inspection and inquiry of the client, the 4 detected misstatements appear to be unintentional processing errors. For example, discount granted were not recorded, or in the case of Learn Heart Centers, the merchandise was returned prior to year-end, but the credit was not processed until the subsequent period, like in this example. If misstatements are found in the sample, the auditor needs to calculate a projected misstatement and an allowance for sampling risk. Because in an MUS sample, Each selected dollar represents a group of dollars in the population. The percentage of misstatements in the logical unit represents the percentage of misstatements in the sampling interval from which the dollar was selected. There are three types of situations can occur with detected misstatements. First is that the logical unit is equal to or greater than the sampling interval. In this situation, the projected misstatement is equal to the actual misstatement detected in the logical unit. In this example, the Accord Corporation contained a balance of $32,549, which is larger than the sampling interval of $26,882. In this example, the projected misstatement associated with this account would be $22,500, and no sampling risk is added. No allowance for sampling risk is necessary for this large account because all accounts larger than the sampling interval will automatically be selected by an MUS sampling approach. Since all dollars in the large accounts are audited, there is no risk of additional potential misstatement associated with large accounts. Okay? And the second situation is that the logical unit's book value is less than the sampling interval and it's misstated by less than 100%. This is the most common situation, and the percentage of misstatement in logical unit is referred to as the tenting factor. The tenting factor equals to book value minus audit value divided by book value. For example, in this case, the Good Hospital Corporation account is overstated by $3,284. Thus, the tenting factor for the account would be 21,893 minus 18,609, which equals to 3,284. Then we use this number divided by the 21,893. Then we got the tenting factor equals to 50% or 0.15. Also, another situation is that the book value of the logical units is less than the sampling interval and it is 100% misstated. Because the logical unit represents the group of dollars with the sampling interval, the sampling interval is assumed to be 100% in error. So in this example, the audited value for Learnhardt centers is 0. The projected error for the interval containing this logical unit is 22,882, which is determined by multiplying the percentage misstated, which is 100%, by the size of the sampling interval, is 26,882. Then let's see how to calculate the upper misstatement limits using the tables, attribute sampling tables. To compute the upper misstatement limit, UML, the auditor first computes basic precision and then ranks the detected misstatements based on the size of the tenting factor from the largest tenting factor to the smallest. Projected and upper misstatement limits are computed using the tenting factor and upper limit factor from the table, from like this table, this statistical table. Okay. Then finally, the misstatements detected in logical units greater than the sampling interval are added. Like in this example, we first calculate the basic precision, and then like we find this in the table. For the 95% confidence level, its upper limit is 3. Then the upper misstatement is 90,646, which equals to sample interval multiply 3. And then we find one misstatement item in this table, in this sample, and then we go back to this table. If the sample size is 100, and then the number of deviation is 1, then the upper misstatement limit is 4.7. So here we use 4.7 minus 3, got the upper misstatement limit for this item is 1.7. Then we use 1.7 multiplying the sample interval to get the upper misstatement for this item is $45,700. Then for the Marvel medical item, it is the second deviation we find in the sample. Then we go back to that table, we will find that the upper misstatement limit for the sample size as 195 confidence level, its upper misstatement factor is 6.2. Then we use it to minus 4.7 to get the upper limit for this item is equal to 1.5. Then we use 1.5 multiple the tenting factor 0.4 and then multiplying the sample interval to get $16,130. And for the good hospital, the same. We use the tenting factor, multiple the sample interval, and multiplying the upper limit, which is 1.4, to get this upper misstatement. Then for the Excel Corporation, because it's the book value is greater than the sampling interval, so we just use its difference dollar amount as the upper misstatement. Then finally, we add all this upper misstatement together to get an upper misstatement limit for the whole population. Ranking the logical units by their tenting factors leads to an UML that is conservative because the largest tenting factor is multiplied by the largest incremental change in the upper limit factor. This conservative approach means there is a higher risk that an acceptable account balance will be rejected by the auditor. We can also calculate this upper misstatement limit using ACL. Like we go back to ACL. Also in the sampling, evaluate error. Here for the monetary sampling, like this here, the confidence is 95. The interval is the interval is 26,882. Like the arrows in the example is First, the item amount is 21,893. Then the arrow is 32,184. And then the second item amount is 67,105. And the arrow is 2,682. Then for next one, the item amount is 15,000. And the arrow is also 15,000. And for the last one, the item amount is 32,549. And the arrow is 2,500. Then click OK. It will automatically calculate the most likely error and upper error limit. When compare it to the result here, there is a slightly difference here for the upper misstatement limit because ACL use more precise upper limit factors to create a more exact upper limit. Okay, then let's go back to the slides. After computing the upper misstatement limit, UML, the auditors could draw their final conclusions. For this example, the final conclusion on whether the accounts receivable balance is materially misstatement is made by comparing the tolerable misstatement to the UML. If the UML is less than or equal to the tolerable misstatement, the evidence supports the conclusion that the account balance is not materially misstated. In this case, the UML of $150,621 is more than the tolerable misstatement of $125,000 because the UML exceeds the tolerable misstatement of $125,000. The auditor has evidence that the accounts receivable account is materially misstated. Then the auditor now has four options. First, the sample size can be increased. While this approach is possible, in theory it is not practical in many audit settings. And then second, other substantive procedures can be performed. This approach might be followed if the auditor's qualitative analysis of the detected misstatements indicates that there is a systematic problem with the population. For example, the auditor might determine that 3 of the misstatements occurred in the pricing of one particular product line sold by the client. In this instance, he or she might design a substantive procedure that examines the pricing of all sales in that product line. The third option for auditors is that the auditor can request that the client adjust the accounts receivable balance. In our example, the minimum adjustment would be the 25,621, which equals to the $150,621 minus $125,000, which is the tolerable misstatement. If the client adjusts the account by 25,621, then the UML will be equal or not less than the tolerable misstatement at a 5% risk of incorrect acceptance. Finally, if the client refused to adjust the account, the auditor would issue a qualified or adverse opinion. But this situation would be extremely rare. Like this table illustrates the risks auditors face when evaluating an account balances based on sample evidence. If the evidence supports the fairness of the account balance based on the sample evidence and the account is not materially misstated, the auditor has made a correct decision. If the evidence doesn't support the fairness of the account based on the sample evidence and the account is materially misstated, a correct decision has also been made. The other two combinations result in decision errors by the auditor. If the evidence doesn't support the fairness of the account when it is in reality not materially misstated, the auditor will have incorrectly rejected the account. This can lead to over-auditing and an inefficient audit. If the evidence supports the account as fairly stated, when the account actually contains a material misstatement, the auditor will have incorrectly accepted the account, which is a type 2 error. Since the methodology used earlier in computing the UML is based on the auditor's assumption at the time of planning the sampling application that all errors in the population are overstated. Recall that MUS is not particularly efficient at detecting understatement because under an MUS approach, the probability of selecting a small account is proportionally lower than the probability of selecting a larger account. Thus, an understated account is, by definition, less likely to be selected than an overstated account. So in the extreme case, an account could be missing or it could be 100% understated and recorded as a value of 0. In either case, the probability of the account being selected for audit will be 0. When understatement errors are detected, different approaches can be used. For example, when understatements are entered into ACL, the ACL can adjust the total most likely error downward but doesn't adjust the upper error limit. For example, this table shows an example of the understatement misstatement. Assume that the auditor detected the 4 overstatement misstatements shown in the previous example and that the following understatement misstatement was also detected. Then the most likely errors is now reduced by the projected understatement, which is 2,688, which equals to the minus 0.1 multiple the $26,882. Some auditors also adjust down the UML by the projected understatement to obtain a net upper misstatement limit. This approach is followed when the auditor believes that the overall misstatement in the population is in the direction of overstatement. Then the understatement identified are used to adjust the MUL. Okay, then let's take a look at the non-statistical sampling for tests of account balances. When conducting a non-statistical sampling application for testing an account balance, the auditor considers each of the steps that we have discussed before for the statistical sampling for tests of account balances. Most of the steps are the same as the statistical sampling approach except these 4 items, like identifying individual significant items, determining the sample size, selecting sample items, and calculating the sample results. First, let's take a look at identifying individual significant items. In many non-statistical sampling applications, the auditor determines which items should be tested individually and which items should be subjected to sampling. The items that will be tested individually are items that may contain potential misstatements that individually exceed the tolerable misstatement. These items are tested 100% because the auditor is not willing to accept any sampling risk. Testing all individual significant items produces an emphasis on large items similar to probability proportional to size selection. When determining the sample size, the auditor should consider the level of desired confidence, the risk of material misstatement, the tolerable and expected misstatements, and the population size. While an auditor may determine a non-statistical sample size by using professional judgment, auditing standards indicate that the sample size for statistical and non-statistical sampling should be similar. Thus, it is common for firms to develop guidance for non-statistical sampling based on statistical theory, such as this formula. It defines the sample size equals to the sampling population book value divided by the tolerable minus expected misstatement, then multiply the assurance factor. The assurance factor is identified by determining the level of desired confidence and the risk of material misstatement. This table demonstrates the assurance factor for various combinations of designed confidence and risk assessment. When any form of audit sampling is used to gather evidence, auditing standards require that the sample item be selected in such a way that the sample can be expected to represent the population. Then let's take a look at the selecting sample items. Like the non-statistical sampling for the test of controls. For the test of accounts balances, the auditors can also use the systematic selection as well as the haphazard sampling method to select the sample items. Auditing standards also require that the auditor project the amount of misstatement found in the sample to the population. The AICPA Guide Audit Sampling describes two acceptable methods of projecting the amount of misstatement found in a non-statistical sample. The first method of projecting the sample results to the population is to apply the misstatement ratio observed in the sample to the population. For example, if the auditor finds misstatements of $1,500 in a sample totaling $50,000, the misstatement ratio in the sample is 10%, which is equal to 1,500 divided by 50,000, and that ratio is applied to the population. If the total population is 200,000, then projected misstatement using the ratio approach will be 20,000. This method of projection is often referred to as ratio estimation, and it is used with both non-statistical sampling and classical variables non-statistical sampling. Ratio estimation is used when the dollar amount of misstatement is expected to relate to the dollar amount of item tested. Then the second method, referred to as difference estimation, projects the average misstatement of each item in the sample to all items in the population and is used when the misstatement is expected to be relatively constant for all items in the population, regardless of their dollar size. For example, a misstatement in a sample of 100 items totaled $300 for average misstatement of $3, and the population contains 10,000 items, then the projected misstatement would be $30,000, which equals to $3 multiply 10,000. Finally, let's take a look at the classical variable sampling. Because the classical variable sampling is not used as often as the monetary unit sampling, I'm just going to give you a general overview of this sampling technique. The classical variables sampling uses normal distribution theory to evaluate the characteristics of a population based on sample data. You can see that in this figure, there are two nominal distributed bell-shaped curves that describe sampling distributions. The mean of the distribution is $10,000. Auditors most commonly use classical variables sampling to estimate the size of misstatement. So in this example, let's say that the $10,000 represents the size of the total misstatement in an account or population. The flatter wide distribution here, this one, is based on a sample size of 50, and the taller, thinner distribution is based on a sample size of 200. Both sampling distributions are taken from the same underlying population. Then the sampling distribution are formed by plotting the projected misstatements yielded by an infinite number of audit samples of the same size taken from the same underlying population. For example, the height of the flatter distribution at $9,000 represents the number of times a sample of size 50 would return a projected misstatement of $9,000. Rather than actually taking an infinite number of samples of the same size to form a picture of the distribution is modeled using the mathematical properties of the normal distribution. Thus, a sampling distribution is really a theoretical distribution that models how the means of an infinite number of hypothetical samples of a given sample size would be distributed. A sampling distribution is useful because it allows us to estimate the probability of observing any single sample result. There are two important features of sampling distribution are very useful for auditors. One is that the mean of the sampling distribution will be equal to the true mean of the underlying population. Thus, in this figure, the true misstatement in the population is $10,000. And also, the area under the curve can be used to quantify likelihood. For example, the standard error for the flatter curve is $1,000. If we look at area covered by two standard errors above and two standard errors below the mean, we know that the area captures about 95% of all observed sample results. This is simply a mathematical property of a bell-shaped distribution. The classical variable sampling can easily handle both overstatement and understatement errors. It is most appropriate for populations that contain a moderate to high rate of misstatement. Some applications of this sampling approach include auditing accounts receivable in which unapplied credit exists or a large amount of misstatement is expected, and inventory in which significant audit differences are expected between test counts and pricing tests. So the advantages for the classical variable sampling include: first, when the auditor expects a large amount of differences between book and audited values, classical variable sampling will normally result in a smaller sample size than monetary unit sampling. And second, classical variable sampling techniques are effective for both overstatements and understatements. No special evaluation considerations are necessary if the sample data include both types of misstatements. Third, the selection of zero balances generally doesn't require special sample design considerations because the sampling unit will not be an individual dollar but rather a customer account, a transaction, or a line item. But also there are some disadvantages of classical variable sampling. When using the approach to evaluate likely misstatement in an account or population, some classical variable sampling techniques do not work well when little or no misstatement is expected. Actually, this is the most common situation in an audit. And second, in order to determine the sample size, the auditor must estimate the standard deviation of the audit differences. Since this value is unknown, auditors often use a surrogate such as the standard deviation of the recorded value in the population. However, this approach tends to overstate the standard deviation of the differences between recorded values tend to be more variable than audit differences in most accounting populations. Third, if few misstatements are detected in the sample data, the true variance tends to be underestimated, and the resulting projection of the misstatements and the related confidence limits are not likely to be reliable. Okay, that's basically for today's lecture. I'm not going to go details for the classical variable sampling because it is not used very often as the other two sampling techniques. So if you have a real account data and you're interested in this, you can use ACL to